The U.S.-Iran conflict, starting late February 2026, has disrupted global oil flows through the Strait of Hormuz, a critical choke point for approximately 20% of world oil trade. This has directly affected China, the world's largest crude oil importer, though Beijing is better positioned than many Asian peers, e.g., Japan, South Korea, India, to weather the storm due to strategic preparations. Pre-conflict baseline 2025 data. China imported roughly half of its crude oil from the Middle East, including Saudi Arabia approximately 14%, Iraq approximately 11%, UAE approximately 7%, Oman approximately 6%, plus others. About 45–50% of China's total crude imports, or approximately 35–50% of seaborne supplies, depending on estimates, transited the Strait of Hormuz. Long-term risks. Prolonged disruption could raise import costs, squeeze margins, and hit growth. China's economy is oil-intensive but less so than South Korea's. It may also boost competition for Russian supplies, e.g., with India. Geopolitical angle. China has ignored U.S. calls from Trump to help secure the strait, focusing instead on bilateral talks with Iran for safe passage of its tankers. Some see irony. The conflict indirectly aids Russia's oil market, as we discussed, while pressuring U.S. allies more. Overall, the conflict has squeezed China's supplies but not critically. Thanks to foresight in stockpiling and diversification, flows could stabilize if the strait reopens soon. Escalation risks bigger hits. If you want stats for a specific month, comparisons to India, Japan, or LNG impacts, let me know. Iran was a key, though officially unreported due to sanctions. Supplier. Approximately 12 to 20% of imports, approximately 0.8 to 1.4 million barrels per day, or MBD, often relabeled via shadow fleets, from Malaysia, Indonesia, etc. Pre-war, China received approximately 535 MBD via the strait. Overall, direct impacts from the conflict as of mid-March 2026. Strait disruptions. Traffic has plummeted, e.g., from typical 70 to 80 vessels per day to just a few, with approximately 80% drop in flows. Non-Iranian Gulf exports, Saudi, Iraq, UAE, etc., have largely halted or rerouted cautiously, reducing volumes significantly. Oil flows via Hormuz to China dropped sharply from pre-war approximately 535 MBD to approximately 122 MBD, mostly Iranian crude, as only Iranian-linked tankers are reliably passing, often with Chinese flags, crews for protection. Iranian exports. Iran has continued shipping to China, its top buyer, approximately 90% of its exports, with at least 11.7 million barrels sent since late February, all headed to China. However, overall Iranian loadings fell from approximately 216 MBD in February to lower levels amid risks. Overall supply hit. Broader Middle East disruptions affect approximately 5 MBD of non-Iranian Gulf crude that China relied on. Some rerouting, e.g., Saudi, UAE pipelines to Red Sea, helps marginally, approximately 5 MBD combined capacity, but it's insufficient for full replacement. China's mitigation and resilience factors. Massive stockpiles. China built huge reserves pre-conflict, e.g., approximately 139 billion barrels as of early March, covering approximately 120 days of net imports at 2025 levels. Additional floating Iranian oil, approximately 46 million barrels in Asia offshore, and bonded storage in ports like Dalian, Joshan provide buffers, diversification and alternatives. Sharp increase in Russian crude imports. Pre-war stockpiling boosted volumes, e.g., plus 41% in Jan-February 2026 vs. 2025, hitting record highs. Post-disruption, China ramped up further, e.g., weekly imports up significantly in early March, taking advantage of discounted Russian oil and temporary U.S. sanctions waivers. Overland pipelines, e.g., from Russia, and renewables. Electrification reduce long-term seaborne dependence. Seaborne Hormuz reliance fell from approximately 51% in 2025 to approximately 44% in early 2026 due to more Russian sourcing. Economic buffering. Higher global prices, $100 plus per barrel, raise costs, but stockpiles limit immediate shortages. Analysts note China is less sensitive to prolonged Hormuz closure than peers, with some viewing it as accelerating the green energy transition, where China leads. Broader effects and outlook. Short term. Manageable for months via stocks and Russian shifts. Some refiners, especially teapot Independents reliant on Iranian discounts face margin pressure and possible run cuts, but no nationwide crisis yet.